Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monte, and I want to first start off by welcoming our newest members, and that is, of course, thanks to the regular followers liking and sharing and commenting. We have grown this channel and the number of viewers by about 20% in the past month. And again, that's thanks to all of you. And if you are sharing this link from YouTube to some of the other social media platforms, you're doing a great job, not just for us, and again, thank you for that, but for those who are searching for answers. If we look at this 1 year chart of IWM, it's not hard to see that we've been in a significant downtrend from the beginning of the year. And now we are seeing a test of this support level down here. Now remember, as I zoom into this, you'll see that last week's forecast, I drew this line here saying that we would rally up to 169.42 and then hit the lower level with my target of 159.69. Now my downside target is still in place. And I know we get a lot of folks that come on and say, oh, here it is Monday and you missed your target already. Well, remember, this is a market that oscillates. It goes up, it goes down, and my goal is to show people how to read the charts well enough to position in those trading legs. Now, remember, the main audience that I'm catering to are swing traders, not investors. Now, there are investors that watch this, and hopefully they're not getting too stressed out by my bearish comments, but there's a lot of money to be made on the downside. And if you're following the trends, you'll know that there are two forces at work that drive prices. One is greed, that drives prices to the upside, as you see back here, and fear, which pushes prices lower. Out of those two forces, guess which one is the strongest? Yeah, that's right, fear. And when fear kicks in, the volume starts to move markets very quickly. So if you're looking at that little box down there, you see the price target is 159.69. Remember, that price is most important. It's more important than the date that's in that box, because all I'm doing is I'm copying angles from previous up and down legs. You can see that this downward leg represents an angle that's very similar to what we saw back here. See this red stretch right there? It's very similar to what we saw back here. It's also very similar to what we saw back here. It's pretty much the same angle. So these angles tend to duplicate, and that's exactly one of the reasons why I'm keeping that target in place, because look what happened today. Big red candle on higher volume. Take out your trading checklist. New members, we have a trading checklist that I follow when forecasting. You'll pick up on this each and every week as I repeat over and over again, because repetition is the best teacher. But we have a complete pivot point here, big red candle, volume going up on the way down is bearish. Oscillators are pivoting lower. And notice down at the very bottom as I magnify that, that's the CCI. That blue line crossing the black line representing the zero line, that generally results in a 2 to 4 day movement in the direction of the cross. So we crossed down below that momentum line today. So I'm expecting at least 1 to 3 more days of downside activity. And with that, we might very well hit that downside target. So that is IWM. Now, if I hop to the VIX, and I want to hop to the VIX before talking about the SPY, because the VIX and the SPY, which is the S&P 500 ETF, for the most part, they're inversely related. And it's hard to see this, but as I zoom in there, you see this red line right there. I initially said the VIX would drop to that target of 29.75, and then I said we would start to move up. Well, that pivot point actually was back on Tuesday, and we started that day with a higher price and then ended lower, but it finished up with a candle that looks very much like a hammer pattern right there. And then we have an inverted hammer here and a big green candle. So we're starting to move up. So this upside target on the VIX is still in place at 34.42. Look down below. We crossed over the momentum line. See, we crossed down below. 2 to 4 days we went lower. Now we crossed above that. So the momentum is still pushing us higher. And that's why I'm keeping the VIX target exactly where it is for next week. This is a more or less a work in progress. That's a two-part forecast that I often do. Now with that, let's go hop to the spiders, which is the S&P 500 ETF. And lo and behold, we did not hit that target yet. Let me just extend that price action there. That downside target is $350.66. You can see that we're on our way to that level. So I'm going to keep that target in place for next week. Volume is increasing. Remember, that volume going up while the price is going down tells us fear is creeping in and it's motivating the sellers. So the motivation level of those sellers is high. It's increasing. And down below, as I magnify this, see that pivot point on the stochastics? It's heading lower. That's bearish. And lo and behold, again, another cross below the momentum line on the CCI. So that is bearish. Let's hop to the Qs. Ticker symbol QQQ. This is the ETF that basically represents the NASDAQ market. Right here, you can see same story. Now, very interesting for the Qs, while the volume is going up on the way down, we bounced today off of this support level. Now, I don't think that support level is going to hold. However, when we hit that downside target right down there at 260.23, again, I'm leaving that target in place. There's a good chance that once that target hits, we could start moving back up. Now, I'm not going to say we're moving back up into a bull market, but I think we could see a little bit of a bounce down there. So put a price alert for yourself using whatever platform you're currently using with your broker at 260 or 260.23 if you want to be exact, and then watch what happens. We'll most likely start to see a drop in volume when we get to that level, and then maybe some short-term buying coming into the market. Okay, so that is the Qs. Now, finally, diamonds. This is the Dow Jones Industrial ETF, ticker symbol DIA. Same story. We got that pivot point. This moving average, by the way, has been acting as resistance. You see that whenever it gets up to that moving average lately, it's been pulling back from it. So we have this completed pivot point to the downside. Again, oscillators are going down. The CCI is crossed the momentum line, still going down. So that downside target for the diamonds is also staying in place until next week. That target is, drum roll please, 282.32. That's the diamonds. Now, let me just give a heads up to those who like to focus on the charts but don't necessarily like to hear about the geopolitical situation around the world. Well, this is your time to either bail out or hit the pause button and just sign out. It's up to you. You know, listen, I know a lot of people don't like to hear the negative news, but what I'm about to show you is absolutely affecting the markets one way or the other. So if you are not interested in that, then go ahead. You can close out of your window. Give you a chance to do that right now. And now let's go into the geopolitical picture. Remember, last week I talked about OPEC Plus. This is the slide that I showed you last Friday. And I said, watch out, because OPEC is coming out with news with regard to production cuts. And what happened? Bam. That's what happened. They shocked the market with a 2 million barrel cut in production, 2 million barrels per day. That's a huge cut in production. They started off last month talking about 100,000. Then they went to 500,000 earlier in the month. Last month they said, okay, we're going to go to 1 million. And then they shocked the analysts with a 2 million barrel per day cut. So what happened immediately? Markets started to rally in the oil sector. I'll get to that in a little bit. But why is this so important? Well, this is why it's so important. I showed this one a couple of weeks ago, and the strategic reserves are now being depleted at the fastest rate in history. Look at these red bars. See this? This is oil coming out at a record pace. This has now become a national security issue, actually. We need that oil reserve in the event of a major emergency, a national emergency, and we're not going to have it. And you remember that Biden said that he would be buying oil at $80 a barrel. I'll show you that chart in a little bit. And that did not happen at all. So the analysts are coming out now saying, okay, how OPEC's production, this came out from Barron's on the 4th, how it could spark a rally, more or less, and climb to 100. Well, we're almost at 100 already, believe it or not. The oil futures spiked up. They continue to go up on high volume. And again, this is something that can keep on going and only add to inflation, although the inflationary numbers do not measure energy and food into the core inflation, although they should. They used to. They don't, to make that a little bit more digestible to the average American. But the fact is, higher oil prices down the road are absolutely going to hurt our economy, no doubt about that. This is a chart of the futures. Now remember, I showed this one as well. As we were approaching on this red candle, I talked about that. I said there's a good chance if Biden says he's going to buy it at 80, someone's going to come in and try to buy it at 81. And of course, we had people who were paying very close attention to that comment, said, well, what's happening now? It's dropping below 80. What happened to the big rally? Well, you wait 2 days and there it is. There's the big rally. Went from 79 to 92, almost to 93 right now. Now, the important thing to look at here on this particular chart is this line that we have as a downward trend line. This is a pattern known as a triangle pattern. It's a symmetrical triangle. And now that the volume is increasing on this breakout, we could see oil prices go a lot higher in the coming months. And notice, we don't see any increase in volume when it got down to this 80 level. In fact, the volume dropped on the futures. What does that tell me? It tells me our government did not buy anything down there. They didn't do what they said they were going to do, and now we're stuck. Americans are going to have to pay to replenish that at a higher price, and that's going to cost taxpayers once again. Now, looking at this moves more to an economic picture where the job openings right now are at a level that is what we saw back in the COVID crash. Now, I'll zoom in right here. You see this? This is the biggest monthly drop on record outside of the pandemic. And keep an eye on this because this is last month's bar. Coming into October, I don't know what to expect, folks. If we get a bigger bar on the downside, then that means we have a record drop in job openings. That is an economic leading indicator that will play into our down market. And while that might sound ominous and like we have a dark cloud hanging over our heads in the market, please understand as option traders, and you could ask any of our members, we make money on the way down. How? Because we position ourselves in option spreads that are bearish in nature. And please, just don't go out there and start trading options until you take a course with Market Rebellion, of course, and learn a little bit about the risks at least. And then if you decide to trade options, just start off tiptoeing into the market and trade little bits at a time. And then as you get more proficient at trading, you could, of course, increase the amount that you're putting into that trade. You see? So now what's next on the agenda right here? Well, we got the job openings are dropping pretty rapidly. But this came out through the Wall Street Journal yesterday. Cargo ship owners are canceling sailings as the global trade flips from backlogs to empty containers. What does that mean? It means that the energy-driven inflation that I just described in the oil markets has collapsed consumer spending. These cargo ships rarely ever sail with empty containers. That's like a tractor trailer going bobtail without pulling any trailer behind it. It's negative income. You see, this also is a leading indicator that you have to keep a watch for. And so I'm just giving you how it's all stacking up and the reasons why I think a lot of these bullish analysts are absolutely wrong. I think that it's only getting people in trouble. And the evidence is just stacking up. Look at Amazon. They're freezing corporate hiring. Now, Amazon is a well-run company. They have executives and teams of people who analyze economic conditions and make the adjustments internally to more or less offset any risks that they see as a corporation. So when they start the hiring freeze here, that means they're preparing. They're more or less bulking up or getting leaner so that they don't have to take a big hit should sales drop. And that's what well-managed companies do. They think ahead. They look out there. They probably don't watch CNBC and some of the other programs that are still forecasting, rosy picture in the economy. This is not a rosy picture. And in fact, our economy is driven by small businesses. That's the backbone of the U.S. economy. Now, if you look down at the bottom of this page, 35% of all small businesses couldn't afford to pay their June rent in full. Now, what does that mean? It means they're hurting in sales. And if they have to file for bankruptcy, which may happen over time, we're going to start to see that happening, small businesses going out of business. This is going to put a hurting again on the entire U.S. economy. So another leading indicator to keep an eye out for. Now we hear about what's happening in Ukraine. I tell everyone, yeah, you can watch that, but keep your eye on China. I'll get to that in a moment. But look what's happening in spending. A lot of people don't really realize this until they see it on a chart. We have already spent $25 billion in aid to Ukraine. If you take your little calculator out and total all this up, we're almost 3 times more, 2.5 times more than all of those other countries combined. What's wrong with that picture? Well, a lot is wrong with that picture. Why? Because the U.S. taxpayer is footing that bill as well. These pressures are adding on top of one another into the U.S. economy, and it just keeps compounding. And it's almost like these are daily events that are coming out. I mean, I'm putting these out to you in sequence of the way I found them. And of course, last week we got hit with Hurricane Ian. How would that affect the rest of the country? Well, it will. FEMA comes in, that's taxpayer dollars. You have insurance companies taking a hit. What does that mean? They're going to have to raise rates on other Americans that may not be in a hurricane zone. You see, this is $47 billion hit so far, and that number is still rising. My son lives down in Fort Myers. I mentioned that. And this is what you're seeing on the news is what's happened in his backyard. He's sending me live videos, and it's just absolutely devastating. It's going to take years for that part of Florida to recover and rebuild. They will. You know, Floridians are strong, but they will. They'll rebuild, but it's going to take a while, and it's going to take a lot of money to do that as well. Now, this is something that just happened. We had Attorney General Paxton from Texas file a brief with the Supreme Court to protect taxpayers from the skyrocketing cost of illegal immigration. Now, read this little bottom here. It's completely reprehensible to expect taxpayers to foot the bill for hundreds of millions of dollars to sponsor more and more illegal aliens. Now, whether you support these folks coming in over the border freely or not, it's going to be a cost, and a big cost to our economy. In fact, if you look at this slide, this is a graph that shows the difference between what California is paying, $21.76 billion. That's the cost of illegal immigration in California, and that's this little dot over here. You look at New York, which is in second place here, and then it starts to trickle down. But you might say, well, I don't live in California. How's that going to affect me? Well, farmers live out there. You have people that are producing products and services for us as we buy or import from California. You can look at it that way. If this was another country, we're importing from that area. So the cost of doing business goes up for them. They pass on that cost like any retailer would to the consumer. So this affects all of us, absolutely in a big way. Now remember, I was talking about China. Don't take your eyes off of China. Here we go. This is a recent tweet from the Ministry of National Defense. Understand something, that the folks that post the tweets right here on Twitter from China or Taiwan, they hire people that are very good and have mastered the English language. So when I read something like this, I take it literally. The key word here is situation. You see this? They say the situation. What is the situation? There's events happening in the Strait of Taiwan here that is causing the military to respond to that situation. And they are responding with military aircraft and naval vessels. Keep your eye on this, folks. This could, I'm not saying it will, I'm saying it could. This is my opinion. Remember, it does not reflect market rebellion. This is my own personal opinion. You absolutely have the right to disagree with that. And if you do, post your opinion. I openly welcome opinions and a difference of opinion of mine. Maybe I'll learn something from you, you learn something from me, and we're better off for it. But whether you agree with this or not, you have to understand that things are heating up, and I believe that this could wind up being a black swan, especially for the semiconductor sector and the Qs. If something happens in Taiwan where China just decides to start moving in there, you're going to see pressure in our markets as well. Now, before we go, I want to thank a few folks, and this is just a testament to the type of folks that we have at Market Rebellion and the membership. You know, after I mentioned Hurricane Ian and the devastation that took place in Florida, a group of our members came out and said, you know what, let's organize some trades here that we can do in the market, and we'll donate some of that money for hurricane relief. So I want to do a shout out to TJ. I'm using first names only, obviously, for privacy reasons. But TJ, Stacy, Jerry, Daniel, Alan, thank you so much. That is what it's all about, folks. If you can make enough money for yourself, your family, your retirement, and you can make extra money to go pass it forward and help someone else out that's less fortunate than you. That's what it's all about, folks. For me, that's where the rubber hits the road. That's what I take to heart, and I work harder, especially for the folks that are so generous and have such big hearts. Thank you, thank you, thank you so much. I really appreciate that. You have no idea how much I appreciate that. So remember, thank you again for liking, subscribing. Just hit that subscribe button. Hit the share button. Of course, you want to share that to social media, and then hit that notification bell, and you'll be notified when this market report goes out. So once again, you have a good rest of the week, and we'll talk to you next time. So long.
As traders, we are beholden to forces greater than any one person. Forces that can lift spirits or leave scars. There are those who passively resign to their fate, leave their decisions to others, and let the chips fall where they may. And then there are the rebels, a battle-tested team of expert technical analysts, astute educators, tactical momentum traders, crypto connoisseurs, and the select few who take the market head-on so that they may have a say in their own destiny. Guided by the mantra, discipline dictates action. Discipline dictates action. Discipline dictates action. Today, we rebels gather, a community of mavericks, forging a path through the ups and downs on our own terms. Welcome to the rebellion.